The information in this podcast is general information and not advice. Stanford Financial is authorised under Australian Credit Licence Number 541480. Further information is available at stanfordfinancial.net.
Well, hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complicated world of buying and selling real estate. Obviously, I'm Steve Athanates. I'm from NG Real Estate Ipswich. Today, we're talking about the Reserve Bank decision. Today is the 6th of June. We've had a decision, and of course, we're talking to our best friend, Steve Beach from Stanford Financial. Now, Steve, this is one occasion where I'm sad that I was actually right.
You were right. I owe you a beer. That is 100%.
So what happened with interest rates?
So they did go up 0.25%, so another rate rise. So that's 12 rate rises in the last 14 months.
Ouch.
We have seen, I guess, back in April last year, we saw the cash rate at 0.1%, and we're now at 4.1%. So 4 percentage points gone up by.
Yeah, look, obviously it's a bit of a sad day for everyone concerned. Obviously, for all those people out there with a mortgage, commiserations. Obviously, hopefully the pain is drawing to an end. We thought there was going to be at least one more before the end of the year, but we're hoping it wasn't going to happen this month. Obviously, there's a number of factors that have come into play, which we talked about off air, as to why we think it's come about. Obviously, we talked about the fact that we've had a federal budget. There really wasn't anything in there that tackled inflation sort of head on. So obviously the Reserve Bank has been left with the big weight of dealing with inflation. And what else happened this week?
So I guess a couple of things to take into consideration. So ultimately there was the wage rises that are coming into effect. We're also talking about I guess just cost of living in general. The biggest predetermining factor I think that we saw with the economist decisions was fuel. So transport costs was actually higher than anything else that we've seen.
Did you notice fuel just went up like 40 cents a litre?
Well, I fueled up at $1.61 on Saturday, and then Saturday night we drove around. It was $2.01 everywhere, so 40 cents.
Yeah, I don't know how they justify that. How does fuel go up 40 cents a litre in like one day?
It's crazy. So
it never comes down 40 cents a litre in one day, does it? No,
I've never seen it do that. No, definitely not.
So look, I understand exactly what you're saying. Obviously, we've got the cost of living pressure associated with fuel. Obviously, groceries. Just about everything you want to think about is dearer than it used to be. So obviously that's putting some real strain on people. Obviously the Reserve Bank is trying to slow down consumer spending.
Household expenditure. So big thing with that. I guess in the last podcast we did talk about the RBA did say that although they lifted last month, we were potentially going to see at least one more or even potentially two more rate rises before the end of the year. I guess they probably pulled the trigger early. I think that's probably a decision made in the factor of with end of financial year sales coming into effect, probably everyone to pull the handbrakes a little bit and reconsider some of that consumer spending. A big thing that also came out, goods sales have been reduced, but services costs have actually increased, which we've probably all seen with sort of tradies and going to the doctors and all that kind of stuff. Even though we've seen with part of the federal budget, they are increasing the doctor levy. So there should.
I think for certain people though, isn't it though? Really, isn't it certain groups? You have to be under 18, or if you're more mature, certain
levies and stuff like that in regards to it.
So look, obviously there is a lot of pain out there right now, and obviously it gives us no pleasure to report obviously that interest rates have gone up again. The things for consumers, Steve, now, are there any products, are there any services available to people who are financially stressed from a mortgage point of view?
So I guess a couple of things that we've been finding, and my team's actually been reaching out to pretty much all our clientele that engage with us. We call it on our book. Just touching base, just seeing if we can help in any way. So the biggest two biggest predetermining factors we've been doing is, particularly for mortgage holders, is consolidating debts into the mortgage. So the big thing that a lot of people are talking about is coming off a 2% fixed rate and rolling into almost a 6% variable rate at this point in time, or even potentially fixed rates. it's a high jump. So it's probably $1,200 per month extra in repayments. So one way to try and alleviate that is to potentially debt consolidate. So pay out the car loan, pay out the personal loan, pay out the credit cards. The other things a few people have been talking about on the media is, reach out to in my point of view, broker, or to your bank, talking about refinancing. And a few people said, but all the banks are all very close with the interest rates. The big thing about refinancing is you may be 6 years into your 30-year mortgage, so you're currently sitting at 24 years left. So what we could potentially also look at doing is restarting that mortgage back over 30 years, just to try and relieve some of that pressure there.
So that's really, it's going to obviously increase the loan term. So say you were 10 years into a 25-year term, you can refinance it back out to 30 years. And then it's obviously going to bring your monthly repayment down quite significantly.
Yes, you might save sort of $200 a month or something like that. So it's not huge in comparative to the rate rises. But if you then consolidated, say, a car loan that you might be paying $600 a month, so you got $200 here, $200 there, get rid of your credit card, might be $180. All of a sudden, we're now pushing around sort of $780 to $900. Worth of savings that you can potentially find. So you're only then finding an extra $300 a month out of already a stressed budget. The next big thing that we're seeing a lot of is what we're talking about is called mortgage prisoners. So whereas you can't refinance because of either you're not meeting the bank's accessibility, because whatever interest rate that you get from a bank, the banks actually have to allow for a 3% rate rise. So like we saw during COVID period, they started rates at 2.5%, even though people were getting at 1.8 and so forth. They put a 3% buffer on it. So you had to service at 5.5.
This was for APRA regulations?
Yep. And then now we're still seeing that 3% buffer on the current interest rate. So if rates are going to now be 6%, you now have to afford the loan at 9%, which is just pushing what we call a serviceability out the window. So we are seeing multiple banks now reaching out with what we call a simple switch. So whereas whatever your mortgage repayment is right now, so you've come off your fixed rate and your mortgage repayment might be, say, $4,000 per month, we can actually refinance you through some of these banks. As long as your repayment is lower by $1, we can then simple switch you straight across to another bank. So to retake it back over 30 years and everything along those lines. From a compliance perspective, we still actually have to make sure that you can afford to make those repayments, but ultimately there's not as much involved in regards to having to send down proof of income and everything to the banks.
So what would be the advantage of someone doing that? Like, how would that help them?
Well, if you bought through COVID, you might have only had a 5% deposit. So your equity position, or what we call in the banking world as LVR, is at 95%. So which means you're getting an interest rate in the higher end of the scale. So you might be coming off your fixed rate at almost 7%, because that's what, if you've only got a 5% deposit, potentially rates will be.
Yes.
As where if we were to do a revaluation and then have a look at what equity you've built during COVID, because property prices are still going up, which was part of the...
Well, they went up about 30%, and we've talked about this before. So if you got a 30% increase on the value of what you paid for the property pre-COVID, obviously you've got some equity.
You've got more than 30% more equity in your property. So now you'll be in a bracket of what we call is sub 80. So which means there's no lender's mortgage insurance. You're getting sort of the prime rates on the market, and even some banks get better rates if you can have 30% or even 40% equity in your property. We can then take you from your existing bank to one of these new banks, take your loan back over 30 years and reduce your repayments. So you can't do debt consolidation in regards to simple switch, but you can definitely look at getting that sort of cheaper repayment.
Yeah. Look, obviously, I think we all agree. It's a difficult time. For lots of people, everything is incredibly. It feels like everything's incredibly dear. Now, obviously, interest rates have gone up again, so that's put more pressure on people. So, mate, got to ask, what's going to happen next month?
Well, I guess in the last podcast, I said rates were going to hold. I was wrong. But I did also say I thought rates were going to go up in either July or August. So I think the RBA have pulled the trigger early. So me personally, I guess all the bank economists all predicted that rates were on hold this month, and it was pretty a shock and awe to everybody that rates did actually go up. So whether that means, like I said, they've pulled the trigger early, and which means we may now not see any more rate rises for a long time. So I think the big thing that I guess, world economy hasn't really changed too much, but if you look at what's happening in the US, so their inflation is only sitting at 4.9 versus us just shy of 7%. But their cash rate at the moment is 5.25 as we're sitting at 4.1. So we are in a better financial position that way. The Australian dollar did go up 0.7% against the greenback as soon as the announcement happened. So positive things for importing, exporting, that our Australian dollar still stays strong. But yeah, I'm probably going to go out on a limb and say I don't think there's going to be another rate rise. I think if anything, we will start to see, I don't think there's going to be any rate cuts coming anytime soon. But as mentioned, early next year, I still think we will probably potentially see sort of 2 or 3 rate cuts early in the first 2 quarters.
I think it's worth, I guess, trying to end on some sort of a positive in terms of the fact that whilst it's painful and it's difficult for people, the sun's still going to rise tomorrow morning. It will set tomorrow night. We all have to obviously tighten our belts a little bit further and obviously just do the best we can with what we've got.
Definitely.
So my prediction, unfortunately I was right last month, sadly, but my prediction is, unlike you, I'm thinking this rate rise was hopefully just to try and head things off at the pass. So I'm going to go with you and hope that next month there is no further increase. Yes, fingers crossed for all of us. So we'll see what happens. Obviously, we'll come back again in a month's time. We'll have the same conversation. Hopefully, we're both right on that occasion. We're both hoping that rates are put on hold. So from us guys, thanks for tuning in. And I guess to see more of On the Couch with Steve, all you need to do is obviously subscribe to the link below here. Special thanks to our guest as always, Steve Beach from Stanford Financial. So if you need assistance with your finances, particularly in relation to your mortgage or debt consolidation, reach out to the boys and girls at Stanford Financial. They'd love to be able to assist you. If you have an opinion about what we've talked about today, obviously it's an extremely topical subject. We'd love to hear from you on our socials. And let's please stay tuned for more of On the Couch with Steve.